Good morning, everyone, and thank you very much for joining me. This is the Market Review. It's Tuesday, it's the 11th of October. My name is Russell Shaw, Senior Market Specialist at FXCM. My email address r@fxcm.com, and I want to thank everyone for joining this morning. I'm just going to bring up our disclaimers first. The high risk investment warning. May I just confirm that you guys can see the screen okay, and can you hear me okay? Hey Zanetta, good morning to you. Nice to have you on the webinar. Thanks for joining. Thank you everyone for signing in. All right, here's our market commentaries disclaimer. Hey Anna, morning to you, and welcome as always. Here's our references, MarketScope 2.0, tradingview.com, and of course the Bloomberg. I'll just bring this up on screen while I go through the Bloomberg EM5 things start today. The first headline is it's just a horrific headline, targeting civilians. President Vladimir Putin's blitz of missiles against dozens of civilian targets in Ukraine, including critical energy infrastructure, marks a major escalation as he tries to overcome a string of humiliating reverses. Russian officials and Kremlin allies cheered Monday's strikes, which hardline nationalist voices have been urging as Putin warned of more attacks if Ukraine continues what he calls terrorist acts on Russian territory. The European Union denounced the missile strikes as war crimes, and French President Emmanuel Macron said they reflected a deep change in the nature of the war. The next headline reads, Yield woes. UK bonds slumped after the Bank of England's moves to increase emergency backstop measures failed to reassure the market, suggesting there's plenty more chaos in store for traders. That's very interesting. Inflation-linked debt was the worst hit ahead of a bond sale, with the yield on 10-year inflation-linked bonds rising 64 basis points to 1.24%. That was more than double the size of the move in conventional debt and a record in data going back to 1992. So effectively, what there's a run on British gilts here. Investors are effectively running for the hills. Investors are dumping UK assets once again after a sell-off that started in late September on concerns about the new government fiscal policies, while the BOE announced new measures to ease the pressure on pension funds caught up in the rout. So that's the big deal. Yeah, pension funds are at risk. So we just got to keep an eye on that. It also confirmed its first program of emergency purchases would end as planned on October 14th. Fuel shortages. France's drivers face more fuel shortages as unions plan to prolong strikes at the country's biggest refineries that have left almost a third of its gas stations with supply shortfalls, following unsuccessful wage talks on Monday with the management of ExxonMobil, which operates 2 refineries in the country. The CGT labor union that's leading the walkouts urged the government in an open letter to mediate. Workers at the Total Energies refinery in Normandy have also decided to prolong the strike until at least Tuesday, the union said. The government of President Emmanuel Macron and the companies are under pressure to end the stalemate as long lines at gas stations continue to make headlines. So we've had 3 really terrible headlines, so to speak. Xi's dream at risk. At the once every 5-year Communist Party Congress this month, where President Xi Jinping is set to secure rule until at least 2027, policies on the table will help determine how quickly China surpasses the US economy or whether it ever will. Bloomberg Economics has sketched out 4 scenarios for China's economy over the decade ahead, with a base case of 4.6% growth on average over the next decade. The model suggests a growth rate above 5% over that time period, as predicted pre-pandemic, is now out of reach due to the lasting impact of COVID zero policies, a faster decline in fertility than previously expected, and low investment due to a gradually shrinking real estate sector. Retreating from treasuries. Everywhere you turn, the biggest players in the $23.7 trillion US treasuries markets are in retreat, from Japanese pensions and life insurers to foreign governments and US commercial banks, where once they were lining up to get their hands on US government debt, most have now stepped away. And then there's the Federal Reserve, which a few weeks ago upped the pace that it plans to offload treasuries from its balance sheet to $60 billion a month. I got to just check that. I thought it was at 95 billion. All right, that's interesting. For every one of them to pull back is an undeniable source of concern, especially coming on the heels of an unprecedented volatility, deteriorating liquidity, and weak auctions of recent months. Okay, so there's an issue on the UK gilt market. There's an issue on the US bond market. Effectively, investors don't want to hold these securities. So what's effectively happening is we're seeing yields move up, right? Because they're inversely related to prices. We'll just look at that very briefly. Coming up, European stocks are set to follow Asia and US lower amid concerns over interest rates and geopolitical tensions. The IMF publishes its World Economic Outlook and Global Financial Stability Report. Ukraine will halt exports of electricity from Tuesday after Russian strikes hit power facilities. Facebook parent Meta holds a conference on augmented and virtual reality. The BOE's Andrew Bailey and the Fed's Loretta Mester speak at events. Expected data include UK unemployment and Italian industrial production. LVMH reports sales today. Let's take this guy out and change this to gilts. Let's just get an idea of what's going on here. Let's just change this to US 10-year. All right, let's yes. So we're looking at the US 10-year. We're looking at the British gilt, which is the 10-year. Hey Howard, morning. No worries. Hey Katie, good to have you guys on the webinar. Let's actually put in a correlation coefficient here, and then I've got to think about if there is any real sort of reason for any correlation if we do see one. I guess there is actually. Let's put this in. All right, so the let's go into the weekly. Yeah, it's a very strong correlation. Okay, so I think just a few sort of takeaways from this. First of all, the correlation here is almost close to being perfectly positive. Hey Mia, 182. I think that's more an inflation story than anything else at the moment. And I think this was a deflationary story, so a sort of deflation into inflation. So I think that's actually what's causing the correlation here, as opposed to each sort of region's domestic bond market concerns. I think the underlying factor which is linking the correlation here would actually be inflation. So that's the first observation. There is a steeper gradient, it looks to me. Let me just. So there's a steeper gradient here, not by much. Okay, so it's just that the bond markets at the moment are in a bear market. There is added complexities when it comes to the UK bond market clearly, and I think we've got to watch the politics out of there, because I think the debt holders will be watching that very carefully as well. That they're already spooked. Okay, so I think you know, just sort of I don't want to make this political. Not advocating for one party over the other. What I would suggest though is that Liz Truss needs to sort of pull a rabbit out of a hat here, because I think the bond markets are going to be watching the gilt market. All right, let's go back to our real rate. Okay, is this right? Yeah, that's right. Okay, and let's put in the dollar underneath that. Okay, so let's add also an RSI here. So it's going to be the RSI of the real rate. Okay, so this is interesting. I'm not quite sure. I'm not quite sure how easy this chart is to read, because I think there's ambiguities. All right, let's just push this down. Let's pull this down. I think the first obvious takeaway is that the interest rates remain overbought. We noticed that it seemed to have corrected. However, the truth is it's still very much above the sort of threshold that we use to gauge if the market is frothy, and it is frothy. The issue with a weekly overbought is it can take weeks before this unwinds. So this is in the quarterly report, and in it I say we're overbought, but I don't know if it's going to resolve in the fourth quarter or not. Now, and that's just because maybe it resolves after 12 weeks. The weekly chart is very, very difficult. But if it does normalize, if we get a movement back out, then I still would suggest counter trend rallies are the likely effect of that. So the cause would be a pullback in yields, and then the counter trend rallies ensue. But where's the ambiguity? Well, you have to take a look at the chart over here. And we're on the weekly, right? So we've got a higher trough here. Let me zoom in. So here's the reference candle. So last week's low, okay, is the lowest low in at least 3 candles. It's only Tuesday, so we've got to see how the market ends. How this candle ends. CPI is going to play a big role here. If the CPI number beats it comes ahead of forecast, this is going to shoot up. If it comes in under forecast, then this is going to come down, and then we won't get the reference candle. But it looks as if there could be a reference candle which means that there could be another leg here, which would be interesting given that we are overbought, which makes for very complex analysis, because what do we do in this type of situation? So the idea here is, I think, just to keep the overbought condition in mind, because I think at some stage it normalizes. Then the market dynamics do a 180, right? We'll see the counter trends, but I'm not sure that those are meaningful in terms of primary trend change. So we're going to have to still keep monitoring that. It makes for a, I think it's going to make for a difficult quarter. So the idea is, well, what exactly can cause the pullback here? It seems that the higher yields are the correct reflection of underlying macroeconomics, especially the monetary policy. Katie just asking to see the stochastic. I'm just going to bring that in. Okay, so very strong momentum there, Katie. Very strong momentum. So obviously, the longer it stays above 80 on the stochastic, the greater the likelihood of higher real rates. But the longer then we stay overbought, and that means when the longer we stay overbought, by the way, the harder the likely pullback. But the obvious question to ask here, I think, is how is this correction in pullbacks going to manifest? So let's just go through very quickly the dynamics of the bond market. I'm not going to take this out. I'm not going to spend too much time on it, but I just want to show you the inverse relationship. So we're just going to make, we've seen this before as well. So we're just going to work on something called running yield. Running yield's not really, it's not the appropriate way to look at, it's not an appropriate way to look at bond market yields, but it's going to make the point here. So we're just going to take, so running yield, just trying to remember the formula. I think it's annual coupons over price. I believe that's the subject to correction. So when you buy a bond, you obviously you're not buying you're lending money. That's effectively what you're doing. So let's just say you're lending money to the US Treasury. They're going to pay you what's called a coupon, which is effectively like an interest payment, right? And your coupon, let's assume your coupon is 10%. Okay, let's call it 10%. Let's also assume that you have loaned the money for a bond that is effectively valued at $100. Okay, so well, 10 over 100, right? 10 divided by 100. Well, that's going to give you a 10% running yield. It gives you a 10% running yield. Your coupon's not going to change. Okay, so you as long as you hold the bond to maturity, you'll get paid 10% coupon. But the bonds can trade on a secondary market, and prices change. Your coupon won't change. So if you buy it and hold it to maturity, the price change in a bond is not really going to affect you. But let's just say that bonds are getting absolutely obliterated, which we know they are, right? So let's just say they've gone from trading at $100, okay? Let's just say they're now trading at $50 on the secondary market, okay? So, well, your running yield is 20%, okay? Okay, running yield is 20%. So what's the takeaway? You can see as your price gets hammered, so it's been hammered from 100 down to 50. Okay, your running yield actually acts inverse, doesn't it? It jumps from 10 to 20, and that's so running yield is not an appropriate way actually to look at the bond markets. You're just going to have to take my word on that, but it does make the point that the price of bonds are inversely related to yields. Okay, so what we see here is yields moving up. Okay, because we're looking at real yields are moving up. If I change this to just take out the break even, and we just look at the tenure, okay, then we're looking at the tenure yield. Well, the tenure yield is appreciating. Well, that means the price must be getting hammered, right? So we can take a look at this as the best. I think the best way to look at it is to use the IEF exchange traded fund, and here you'll see it. Okay, so IEF is now looking at bond prices around that 7 to 10 level, and it's being really hurt. And if we take this on a monthly basis, we'll just see the bear market. It's really, here's a peak. So we kind of peak out here, right? And then after that, it's a waterfall effect, right? It's a waterfall effect. So the question, think about this in terms of Dow theory's three bear market stages that we did yesterday. So you've got abandonment of hopes. Let's call this declining fundamentals, okay? And then panic selling, right? So, and this is, by the way, I can't say for sure this is where the actual phases fit in. I'm just trying to make a sort of an educational point here that at some stage there's going to be a panic selling, right, on the bond market. And what comes after panic selling? Renewed confidence. Okay, renewed confidence. So now what happens is there's always market participants testing the water. There's always market participants testing the water. So if they start testing the water now, in other words, they start buying these really beaten down bonds, they start buying because they think it represents pretty good value. Well, let's go back to our running yield example. A coupon will still be 10. And let's say instead of 50, that the market participants now who start testing the water start pushing the prices up. Let's say they go from 50 to 60, right? So now what happens to the yield here? It was at 20%, so now 10 over 60. That will give us, what would that give us? Gives us 16.7%. Okay, 16.7%, right? So what's happened here is that the price here has been bid up. Okay, price here has been bid up, and then what's happened to the running yield? Running yields come down. In other words, if there is any market participants that decide, well, now it's time to start testing the water, okay, let's go back to our yield. Let's just go back to, all right, and then let's add in the RSI here. Okay, so now let's just say that the market participants, they start testing the water, they bid bond prices up. Well, that could be the catalyst that normalizes this. That could be the catalyst that normalizes this. Now, The problem is, of course, they could be testing the water. We could still be in that declining economics phase, and then they sell out, and then of course the uptrend resumes. But it makes the most sense in how does the market actually correct this overbought condition. But it would have to be, in my opinion, on the bond market, and it could be people approaching the UK gilt market saying, okay, the sell-offs, it's too extreme, it's not truly validated. Gilts actually represent good value now. They could go back into the treasury market on the US side. US bonds, they've been hammered, but not to the extent that they should have been. This is an overshoot. Let's get back into it. So that's kind of the thinking that may lead to the normalization. Now, if we get that normalization, this is where it gets really interesting, because then we can bring up euro US dollar, for instance. Just bring that up. And let's throw in a correlation coefficient here. What am I doing? I'm losing my mind. All right, let's put this in, correlation coefficient. Sorry about this. There we go. Okay, let's bring it in. And here, so I'm going to put in euro US dollar, and then we can make some inferences, right? So what happens if going to be a correction here? Well, it's quite likely that the bond market now is being, acting as the catalyst. It also means that yields are coming down. It also would probably suggest dollar losing ground to euro, especially since we see the obvious negative correlation. It's a strong 75, right, to the negative. So any sort of correction here would filter through to euro, but just euro, okay, just like the dollar is adversely affected by the pullback. Risk markets benefit because of the time and value of money, right? So if we get that correction in the RSI here, okay, well, you can probably DAX going to benefit, and we can go into Nasdaq and other risk assets, but it's all really hinging on when does this RSI correct. Again, just to reiterate, it's on the weekly chart. The only way that, in my mind, that I see it really happening is if bond market participants say, look, enough's enough, there's tremendous amount of value, it's time to step in. So the obvious question is, well, when might that happen? When might that happen? And I can't say with any certainty, but I'd look around the 2nd of November, which is when the Fed announcement is, I think it's the 2nd of November. And it could be sort of a buy the rumor, sell the fact type of scenario. So that might lead into sort of a timing. So so there's obviously a bit of time between now and then, but it's making for a very difficult market. Let's just end off with looking at the euro on a day. Okay, so you can see here euro is that's in zone 3. Stochastic is running over until we get that normalization in the RSI. Euro more likely stays under pressure, right? And this just what am I looking at here? That's weird. How did it sneak in? Right, so let me just do that again. Euro in zone 3, and then of course there is then we can kind of look at the central pivot R1, even R2 as resistance, where there might be some selling pressure. Again, I want to just reiterate, I think Q4 is going to be a tough quarter because of this overbought condition on yields. Let's just take a look at DAX as well. Mia asking, do you have to have a higher peak to confirm the renewed confidence stage? So I'll say of course it's going to help, right? So a higher peak, what would be better would be a higher trough, higher peak. You know, the idea is we won't know it with absolute certainty at the time we're going through. Transitions are always difficult at the time. We can see transitions in hindsight, right? Yeah, so we've just got to try and be as objective. A higher peak would certainly add to that objectivity. A higher trough followed by a higher peak would add to that objectivity. The general mood would also add to that objectivity. So if the markets are going up, but there's still sort of a bearish feel around, well, that's probably renewed confidence, because it means that the pros are operating. There may just be an extended sideways movement, by the way. In other words, the market, instead of the markets making that higher peak, it could be actually that they're not making any more lower troughs. So they stopped going down and now they're just sort of ambling sideways. That could be renewed confidence as well. So in that type of situation, there's accumulation going on, but there's no real bidding war that's started yet. And then eventually, as more pros recognize that the bear market's over, and as more pros start buying in, eventually that bidding war starts and starts pushing prices up. So I can't give any hard and fast rules about this, I don't think. It's kind of a macro analysis. So yes, a higher peak would certainly be beneficial. Definitely no more lower troughs would be an absolute necessity, more so than the higher peak. Sideways movement, higher prices amidst bad news, all that sort of type of all those type of things. Let me know if that helps. Something's wrong here. Let me just link this up. Try that again. Yeah, that's better. Okay. All right, so you can see the DAX now starting to fall back into zone 3. The stochastic starting to roll over. Again, this is actually quite an interesting pattern. We have got a bearish signal there, and we actually got a bearish signal here. There is some support. Okay. If the stochastic holds in this lower quintile here, the support will go, I would expect, if we hold in this low. So keep an eye on the stochastic. If the stochastic moves out of 20, then of course we start looking for those rallies in downtrends. If we just see a sustained 20, then I think the market pushes below S1. All right, I think that's where we can. I think that's where we can end the webinar. If there's any questions, let me know. I hope I've covered some meaningful stuff. All right, cool. Let's wrap up here, guys. I want to wish you a good day, a good evening ahead, and we shall chat tomorrow. Tomorrow is Wednesday, so we'll do the cryptos as well. Thanks very much, guys.